And while he's looking, Jennifer, Benjamin Franklin said what? Should be the first page of notes in that section. I actually, where would it be?
245.
Page 245? 345. 245? 245, page 245. And we'll come back to you, Davis. What did Benjamin Franklin say?
That time is money.
Time is money. What did Dr. Fessler say on that same page, Brandon? Money is not free. What's that mean? What's the first one mean? Time is money. What's that mean, Mike?
I don't know.
You weren't here?
No.
Matt, do you know? I got number 1 and number 2. What's number 1?
The more time you waste, the more money.
And then, from the notes. Do you got the notes from that day? It should be number 1 and number 2 right below there. Every capital budgeting problem has 2. Huh? And amount of time is number 1. Mr. Musgrave, what's number 2? Rate of return. Okay, so that's conceptually background information. So what was the first problem we did in class?
Stuffing company A.
Stuffing company A. What kind of a calculation did we do in stuffing company A? Ashton? I'm sorry? Net present value. Which of the tables did we use first when we calculated net present value? Anthony? You know what 2 tables I'm talking about? She's got it. The first one. We did use the first one first, didn't we? We used the first one first. What is net present value conceptually? Armando, how hard would that be? How would you go about describing conceptually what is net present value? You might even be able to find a definition on what page? You weren't here that day? But you might be able to find a definition right. Net present value, NPV. What is a net present value? So read that.
Difference between the present value of expected future cash inflows from the investment and the present value of expected future cash outflows.
Okay. So it's net present value is the difference between the present value of expected future cash inflows minus the present value of expected future cash outflows. And for all the problems that I showed you, the outflow was a one-time investment in time 0, right? So that was easy. And so we just had to calculate the present value of those future cash flows. Now recognize this is really important that we're talking about cash. And there's a couple of pages earlier, Megan, where I say think cash. What's the most simple way to calculate cash from income? If you're starting with income, how do we calculate cash flow? Net income plus depreciation gets us cash flow. Now Heidi asked me before class started, there's a section in the handy handouts that we're not looking at. And that is being done on purpose. You can say thank you, because that is something that, of course you might not like me. The trade-off was you got to do those 2 cases, the one that we did in class and the big one we did out of class, but you got to do those in place of learning cash flows. And you'll get to learn that elsewhere in other classes. So for those of you who are accounting majors, you don't have to feel disappointed. You're going to get to see it later, but you can say thank you that you did not have to learn it for the final exam, okay? So it is there. So there's still that chapter in the handy handbook, but you're not going to be held responsible for it. So very good, right? Very good. And then I just got sidetracked. Where were we? Oh, how again can we get from income to cash? Net income plus depreciation. So I want to make it clear, I just want to remind you that with one exception, all of these methods that we are discussing in this chapter involve cash, not income. Okay, so they're cash, not income, with one exception, and I'll highlight that one a little bit later. So we calculated net present value. Did we also calculate net present value using that second table, Brittany? Yes. Why could we use the second table? What's unique about the second table? It's an annuity. So because this particular problem happened to include the net cash inflows were an annuity, we could use the second table. What is an annuity, Jackie?
Where there was no change between the
Yeah, where the cash inflows for every month were the same, right? Cash inflows for every month were the same. Very good. Any questions, comments, concerns, random thoughts about this particular problem or what we did here? Practice, 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 please. Any? Chance, what was the next problem we did? Stuffing company B, and what type of a problem was that? What did we calculate?
The internal rate of return.
Internal rate of return. Holden, what is the internal rate of return? When net present value equals 0, that percent, because net present value is calculated as well, actually, it's the rate of return that yields a net present value of 0. So it's actually the internal rate of return, it's actually a percent. The answer is a number with a percent after it. So it's actually one of the columns of the table. Across the top are percents, right? There's that. If you go back if you go to the tables, across the top of percent. So it's a percent. So it's one of those labels across the top of the columns. That is the internal rate of return is a percent. It's a rate of return. And it is the rate of return that yields a net present value of 0. Okay? Questions, comments, concerns, random thoughts? Yes, sir.
Did you say those tables were going to be on the test?
Yes, they are. Yes, they are. They're. No, you have to memorize every one of those numbers. No. Yes, it is attached as the last page of the test, so you can even, if I've done it right, and I guess I don't have the double-sided copy, actually, because it is the last page of the test, and I did it single-sided, you can tear it apart even. And so you can tear off the last page and have it separate than everything else. Okay. Very good. What's next, Heidi? Stuffing Company C. I was not in a very creative mood when I named these problems, was I? And when do you think it was that I named these problems? Right around Thanksgiving. Must have been. Or at least close enough to Thanksgiving that I was looking forward to eating Thanksgiving foods. But what did we calculate? One thing before we leave internal rate of return, recall that internal rate of return is calculated by trial and error. Okay, it's calculated by trial and error. Okay. And that's even how your calculators do it. It's just you just don't see all the trials and errors. Okay? So, Kaylee, what did we learn? What did we study in this in Stuffing Company C, as I so unoriginally, Kaylee, sorry. Kaylee, how do we go about calculating, or what did we go about calculating in Stuffing Company C? Payback period. What formula, Sarah, do we use to calculate, can we use to calculate payback period? Original investment divided by periodic cash flow, and that really only works, did I say when that works? It really works when you have an annuity, right? That particular formula works when you have an annuity, because if you recall